I'd love to hear about you. How did you even get into this world of lending? How did you become a loan officer?
Yeah, so I went to NYU real estate school. So I was there. I graduated in 2019, and as part of your senior year, you have to take an internship as like part of your credits. So I worked at a real estate lender called Lafayette Lending, and when I worked for them, I was doing construction draws. So borrowers would come to me whenever they were ready to start drawing on their properties.
Mm-hmm.
Right around the time when I graduated, one of the loan officers there left that company and moved to France. So like fully left the industry.
Wow.
Left me with his book of business. That's actually how I originally got in contact with you guys through Kemp. Because Kemp was one of the brokers
Oh,
that loan officer worked with. So when he moved to France, just left a fully vacant book for me to take over. I graduated and had that. Then went from Lafayette to Patch Lending. There was some merger that almost happened there that didn't, but I ended up working for Patch. Then Patch shut down, and now I'm at so it's been a bit of a whirlwind, but I think like in this space, like a lot of lenders can come and go.
yeah.
And like it doesn't take a lot to become a lender because you could get set up with like a warehouse line and close like 3 to 5 million a month and you're a lender. But then there's larger spectrums as well.
Right.
Yeah.
So while we're talking about, thank you for sharing that. I had no idea. So I've always wondered where you came from and how you
Yeah.
got into this because
Yeah.
it's a different world. And obviously you didn't go the traditional route, which is awesome. But what I think as well amazes people, right, is I've been doing loans with you for a while with Kemp, and you function in a sense like a bank because like a bank loan where you've got the processor, you have it goes through underwriting, you've got loan officers, so that part is obviously still the same, which people are so surprised by. They think again it's just the guy writing the check, they don't really look at the deal, but it
No,
still goes
it's
through that process.
yeah.
But the biggest difference, and you can probably highlight this better than me, but I'm always singing the praises and telling everyone they should go private lending because it's so different than going and getting a loan from a bank. The process is different, the guidelines are different. You would know this better than me. How would you say that what you guys do in your loan process is different than your traditional Wells Fargo loan?
Yeah, and I'd say like there's a reason to take either, like
Sure,
this for a bank loan as well. Like
of
I think
course.
why you would use us is like we have if you're looking for a bridge loan, like we can close in 10 days, like sometimes even less than 10
Mhm.
days. And a lot of times, like especially like in today's like very competitive market, like sellers aren't allowing for financing contingencies because they want to get their properties sold
Mhm.
within a month or whatever it is. Like they don't want to sit around and have it on the market. So like even if your end goal is to get into bank financing, like a lot of times borrowers will come to us first, get the property off the market because we can close fast, and then they'll take a year to get it into bank financing so they find the best program for themselves. So speed is a huge reason why people
Mhm.
use it. I think especially like as you get into like more experienced investors, like the more experienced guys, they don't really use us for anything other than speed.
Mhm.
But then for new borrowers, like we can offer super high leverage that you wouldn't be able to get at a bank. We can give you approvals that you might not be able to get at a bank, for like fix and flip financing, for example, or like rehab financing. A brand new person might not be able to do that at a bank. Leverage is another reason why people use us. If you're somebody who's done at least 5 flips in the last 2 years, you can get 90% of your purchase on 1 to 4 family housing. And then on 5 to 8 units, it's 80% of your purchase.
Wow.
It's still really good. Like it's 80 sounds, it's less than 90, but
Sure.
for somebody who's in that multifamily space, it's, that's still a solid leverage. Like if you're going bank financing, you're looking at like 60, 65.
And that's what I was going to ask because I'll be honest, I've never done real estate loans in the bank route. Leverage. So if I was a newbie, for example, and I wanted to do a fix and flip, I wanted a bridge loan, what kind of leverage would I expect from you and what compared to what I would be getting at the bank?
Yeah, so I don't know exactly bank programs. I do know
Sure.
like for like most cases in multifamily financing, especially it's going to be in like the 65, maybe 70 on a good day.
Yeah.
For us, like if you're brand new and you've never invested before, we'd be in the 75 to 80 range.
Yeah.
And then like I said, as you get more experience, your leverage
Sure.
goes up dramatically.
What
And
about, oh, go
pricing,
ahead. Sorry.
I was just gonna say pricing is like for a new borrower doing a like first time bridge loan, you'd probably be something like 12%, 11%. But then we also have guys who are taking like 8.5, 9% notes
Jeez.
as you get more experience. So
Wow.
yeah, it's pay to play in that regard a little
It,
bit.
it is, absolutely. And another big difference I've noticed is the documents that's required. So, do you guys require tax returns, banks? I mean, I know obviously to close a bank statement, but do you require the same amount of documentation that a bank does?
No, it's a lot easier. So we do need a hard credit pull up front, but that's the only like type of reporting that would be done on your credit. We don't report to bureaus like during the loan process. Then as far as like docs collection, we would need entity docs because most of these are in an entity. Last 2 months bank statements, like you mentioned, basically just need to make sure that you have the money to close the transaction and start rehab, and then photo of your ID, and that's pretty much it. Like it's very short list. Like you need purchase contract and rehab budget, but as far as the borrower stuff, that's really it. And then if you have experience, like we would need to know, like, just some examples of that experience. Look it up online, make sure it's good work. But yeah, that's generally it. It's less than 10 items.
That is drastically different. And anyone that's gone there and gotten a bank loan knows. I mean, they want every bit of information since the time, I joke, since the time you were born, pretty much. It's so much information.
Yeah.
It's overwhelming. So I think that to me in itself, because especially self-employed people, right? I'm self-employed. I try to write off everything because I don't want to give Uncle Sam anything. If I were to go the bank route, they'd laugh at me. They'd go, no, you don't, Whereas you guys are great for self-employed because you're not looking at the tax returns, because the focus is on the property. It makes so much more sense to work with a private lender as opposed to going through the struggle of, fitting in the debt to income and all those pieces there.
Yeah. And so many of our borrowers, again, especially as you get into the more experienced side, like so many of our borrowers are full-time real estate people who don't have full-time jobs. Like, they're full-time investors. So that DTI stuff doesn't always work for them. And that's why.
Right. Absolutely. And you touched briefly on down payment, but I just kind of want to have it come straight from you because obviously we know in the traditional sense, they want to have seasoned funds. They want to know where your down payment comes from. Is that different with you guys?
Yeah. So on bank statements, like we just need to see that the money is there. We're not going to do like any sourcing or seasoning. At the most, I think you've seen this with some of your loans. Like at the most, we might ask for like a letter of explanation. And that would just be like, this is gift funds or this is where I got the money. But again, it's no like real sourcing or seasoning that needs to be done because we understand a lot of people use third-party money.
Right, which is often me. So that's why this works so well. There's been many clients where I've come in to help with that down payment piece, and then it makes the loan work really well.
Yeah, and that's not market standard either for private money.
No, I noticed that.
Different stuff at different shops there. But yeah, we do allow it for bridge loans.
Yeah. And because I have noticed even, with some other private lenders that I'd worked with in the past, some of them were way more strict on, nope, you can't use the capital stacking for the down payment. That's not going to work. Whereas it's been really a great way of working with you because that's helped a lot of people that, either don't have all the capital or maybe they do and they don't want to use it all up on one project. So it's been really helpful. I would consider you're far more of an expert than me at this and real estate loans. What advice would you give for beginners? Because I deal with a lot of people that, I interact with are just getting started. They're considering it. They're just getting started. What advice would you have for them in terms of this?
I've seen a lot, but like, just don't bite off more than you can chew on a first time. Like, don't take on like a super rundown property for your first time. Like, keep it cosmetic. Like, you'll get a better set of terms, and then like, you'll get your experience. And then whenever you want to take on like a bigger project in the future, your lenders will have more confidence. I would just say like start small. There's no reason to like jump into like a multi-unit or like rundown. Like I said, there's still good money to be made in cosmetic flips, and that's the easiest thing to get approved. That's what lenders want to see. So that's what I would say to new flippers. Like, just, don't bite off more than you can chew. Just take on something modest.
Yeah. Well, and speaking of modest, because where you probably obviously know which areas, states are better for finding, those lower priced, good starter ones. In general, is there any that you feel like, obviously Southern California is not going to be a good fit, but are there states where you're seeing those lower priced homes that are good for beginners?
I've seen it. Atlanta has seemed to be a really good market for flipping. Like, there's a lot of like seemingly like 100 to 300K purchase price property like that you can turn for like 450, 500. I've seen that in certain markets in Florida too, like the one that we're working on in Melbourne. That I'm sure that's not even a true flip, and I'm sure they'll be able to get it like a pretty big value add. So yeah, I would say Atlanta probably is the top one right now, but then there are markets in Florida. So Southeast probably is the big hitter.
Yeah. And people don't believe me that they challenge me when I say that properties do exist for, 150, 200,000. They challenge me every time, but I've seen it happen. You've seen it happen. Yeah. They are there. It's just finding them, and I think that's the biggest struggle because a lot of people just look on the MLS. Well, those disappear in seconds, so sometimes that's not always your best resource for finding properties. What do you, and we kind of touched on this as well. Let's let's talk about DSCR because that's the big buzzword, and a lot of people don't quite fully understand what a DSCR loan is. And a lot of people are like, well, why is there that 25% down payment? Why couldn't I get 90% leverage? I would love to hear from you why those numbers just don't make sense if you get 90% leverage.
Well, in most cases, it's not going to DSCR. So like your DSCR is
Right.
your service coverage ratio. And for us, like we have to have that number at 1.15 or greater. But like that's not the entire reason we can't go to that
Mm-hmm.
leverage either, though. Like we just like DSCR loans are, they're a permanent financing product. So they're a 30-year loan, whereas bridge loans are 12-month term. So you're in and you're out. And usually there's a big value boost with a bridge loan. So like if you're giving like a 90% loan to cost, your value might only like once everything's done, your value might be like 60, 50% even in some cases. So
Mm-hmm.
that's why there's the big leverage difference. Like if you're doing a DSCR loan, it's already a stabilized property, so there's not going to be like a big boost in value. So 80% is the highest you can get in leverage for a DSCR loan. 1.15 is that DSCR number, and that essentially means that the payments that you're making from your tenants is greater than what you're paying to your mortgage. So that's really all that means. And it's also like a good loan to get from a private lender because it's based on the asset. That there's not going to be like a big deep dive into your DTI like you mentioned earlier. It's really just based on that debt serviceability of that property. And then that is also lower rates than bridge loans. I mentioned bridge loans are like going to be usually like 9 to 12%, whereas DSCR will be more like in today's world it's like mid sevens, but it's been as low as threes. Like that's the loan that's more tied to bank rates.
Mm-hmm.
But yeah.
So in your magic crystal ball, do you
Oh,
think,
I hate this
what do you
question.
think? I know, do you think everyone asks me, are rates going to drop? And I don't have a crystal ball, neither do you. But I know obviously our hope is that they will drop. I mean, at least you're not seeing them going up. So that's an encouraging thing.
Yeah, I'll say this, we've had two drops already this year.
Mhm.
I'm not one to forecast. I'll just, this is our job regardless. Like we're just gonna have to go with the punches.
Right.
But we're lucky right now. We've had a couple of drops, so come and get it while it's hot.
Well, and a lot of people say, "Oh, it's not the right time to invest. Rates are too high right now." What's your argument for that? Do you think people shouldn't invest right now because of rates and where they are?
I don't agree with like the theory of timing the market. Like I think that it's, you're never really going to be able to do it. I think just if you see a property you like, or if you are ready to start investing, just do it. And there's that saying of like date the rate, marry the property. Like everyone says it, it's all over LinkedIn, but like it is true. Like, you can buy the property now while the market might be a little quieter. There's not as many competitors against you in the market. Take it off the market and then you can refi out in 5 years.
Mm-hmm.
So, I mean, I don't want to give a forecast because I really don't know.
No, I don't. I don't either. I mean, I do think historically,
Yeah.
election years, election time, definitely we will probably see some sort of a change, but
Fingers crossed.
yeah, it's hard to know so hard to know. What about it? This is another one, and I'd love to hear your thoughts on this. So, a lot of people are sitting on a lot of equity. A lot of people have multiple rentals that they've got, they've paid down pretty far, but they're hesitant to do a refinance, even though they want to buy more properties, and that could really enable them to build their portfolio, but they're hesitant just due to where rates are. What's your thought on that?
I don't see it like I mean, if you're somebody who's in like a 3% loan and you absolutely don't want to get out of that, there's always an option to get like a second lien. Like we can do second liens up to 60% LTV, like cumulative LTV. That would be a bridge loan. But like if you have some work that you want to do on that property, you could take a second lien. That way you don't have to like refinance out of your first loan. So that's an option if like that is your strategy, if you have to do rehab. But you could always, like if somebody has that low of a rate, I'm assuming that they've built up some good equity. We have a portfolio DSCR loan. So you could put up to 15 properties in one blanket. And that just, makes everything easier. You have one monthly payment. You only have one loan as opposed to however many you might have had. We have one guy right now he has 39 rentals and he has them all in 39 different loans. He's just getting 3 loans because we can do 15 properties in one loan. He's just getting 3 new loans and cashing out. I think he's taking like 50% LTV and he's still getting over $2 million in cash out.
Wow.
So yeah, I mean, if you build your portfolio in that type of way, you can definitely still take advantage of large cash out.
And see, I'm learning something new. I had no idea about the second lien with doing the bridge. I have, this is complete news to me. I had no idea. I always, and this is where my knowledge lacks. I had always thought when you did a refinance, you had to pay off that first lien, but you're saying if the property needs some rehab, you can get us that second lien as a bridge.
It's not easy to get approval on like the bank. Like it has to be a
Right.
on the first lien. I can't do a second loan where the other lender is also a private lender.
Got it.
So have to be behind a bank there. And the cumulative LTV, like I said, has to be 60% or less. So like if they have a 30% loan, for example, we could give them like another 30% on the value to get them
Got it.
get them some rehab.
Interesting.
Yeah.
I had no idea. Let's talk about, and I promise I'll wrap it up soon.
Yeah, we're good.
With in terms of loan sizes. So what's the lowest you go down to?
We can go down to 150.
Loan size. Okay.
Yeah, loan size and minimum value is 100 if you're going to do that portfolio loan that I mentioned. So of course you would need 2 or maybe 3 in a portfolio to get to that 150. But like I said, minimum 150, maximum is 5 million. Though I have seen like I've gotten approval on an $11 million condo loan, but that's a portfolio because they're condos. Like it's not all one asset.
One, right.
But like one specific asset, I would say the maximum is 5 million.
Okay, that's good to know. I totally lost my train of thought. It was about I can't remember. It had to do with with loan size. Oh, I know. Credit score. What about credit score? What's the lowest on that?
It's 660 and it's a hard 660 for DSCR. I definitely can't go below that. If you're looking for a bridge loan and you have like a 640 FICO and your reason that your FICO score is so low is because of like medical bills or like student loans or even like high user, like high credit, that's probably fine. As long as it's not like anything real estate related. If it's a mortgage, it's not fun. Like we can't. So it's really like we'll still take a look at it. It might be like reduced leverage, but 660 is a hard cutoff on DSCR.
Okay. And that's a big point. And I try to educate people on this. Credit score does play a role in the leverage. It does. And I've seen that where I've seen a client have like a 660 and they were like, why is this so low? And it was because of credit score. I mean, where do you notice that big change? Is it when they get 700 and above? It seems like that really changes things, or?
So I would say if they're below 680 is where it really starts to change. In DSCR, there's bracketing for this type of thing. So like if you're 700 plus, you can qualify for 80. If you're in the 680 to 699 range, it's 75. And if you're in the 660 to 679 range, I believe it's 65. So like there's a drop from one to the other. But if you're 680 plus in bridge, it's probably going to be like pretty comparable. 680 is the hard drop in bridge.
Okay.
Is DSCR.
Does credit score affect the rate at all?
Yeah, it would. It's not going to be like drastic, but it definitely would. Like somebody who has an 800 credit score is definitely going to get a better rate than the 680 person.
Right.
But if you're like anywhere in the mid 700s, it's fine.
Got it. And for some people, credit score is a challenge, right? But I have seen, and we've done this. Is it possible? So let's say I'm the one with challenged credit, but I'm in an LLC with another person and they've got 750 plus. How would something like that be able to work?
Yeah. So if you guys are 50-50 members and you both want to guarantee the loan, I would take an average of your credit scores. So like you would go into the bracket of the average credit score. If that person, like if the average still doesn't get the job done, still doesn't get you the leverage that you want, I would just say make one person a lower member. If somebody is less than 20% on an entity, they don't have to have their credit pulled. They don't have to guarantee. So I would just say be aware of where your credit scores are before you apply and before you fill out your operating agreement.
Got it. And that's super helpful. And we've done some like that.
Yeah.
And in terms of entity, so this is also a different piece. So you guys put you use the entity name for the property, it gets placed in that. So does that mean you're not reporting. It won't report on the person's personal credit report.
Yeah, that's correct. The only time throughout our entire process that you'll see us show up on your credit is when we do the hard pull up front.
Got it.
We would never report on, like, we don't report to any of the bureaus. That's not what, that's the point of having an entity, but that's also like not something we would do either way. Like we're an asset-based lender again. So like if something were to ever go wrong, like, we would get the asset back, but nothing else.
Got it. Okay. That's great to know. And that's a big benefit, I think, for people, because especially if you're going to have multiple investment properties, you don't want to be carrying and showing all that debt on your personal credit. That's
Right.
going to throw you off.
Definitely it can be spooky to first timers, but that's how it works. It's people are kind of scared of the word hard money. I think it's turned into private lending, but that's all it really means is asset-based lending. We look at the asset and not the individual.
And with an entity, is there a minimum time that it has to be formed? I mean, does it have to be 2 years old?
No requirements there. You can make it. A lot of people make it like for a specific property. So
nope, I agree. And that's a big misconception. I have a lot of people that are like, I don't think I can do it. My LLC is not 2 years old. And I'm like, no, you can do it now. There's
doesn't
no
matter. You can
age
get
on that.
like the day before closing.
I know. I've seen that. I've seen that happen.
Yeah.
So I'm curious.
We're very easy
Oh,
with
go ahead.
that. As long as you can get us like what we need by the time of closing, it's okay. Like we're very easy with stuff like that.
Yes, and that's why I love working with you guys. Is you do make it easy, right? It's your ultimate goal is to get that loan closed, and I feel like in other lending institutions, it's not always that same case, right? I don't always feel like their goal is to get it closed. I feel like sometimes it's to make it as challenging as possible. I'm kidding, but
to be fair, like I think that like in this market, like lenders kind of have to play defense more than they have in the past.
Sure.
Like I get sent probably 20 plus loans a day, and like maybe 2 to 3 of them make it to my team. Like I have to win a lot of, like this budget won't finish this. Like, just sometimes it's as small as that. Sometimes it just doesn't make any sense at all. But there's like a amount of defense that you have to play as a lender. Once we approve a loan though, like it's going to go through. Once we give you like preliminary approval up front, like unless something really crazy shows up that like we weren't aware of coming in, like it's going to get through. And like I think you've seen that time and time again. Like once it gets that initial approval, like we'll get it done. And if it's not going to work, like we'll tell you up front quickly, then you move on to the next one.
And that's where people are always confused, because I have a lot of people that haven't even found a house yet, and they're like, Sarah, can I get a pre-approval? And it's different than, I mean, obviously bank, you go in, you get pre-approved for a certain amount. It's not like that in your world. You're not going to say, hey, Susie G, you qualify for 300,000 because you're not looking at the income. So what stage in the loan process, like what has to happen before they've met, they're approved essentially?
Yeah. So I would say 9 times out of 10 people come to us when they're already under contract. They're shopping lenders, typically they know they're looking for private money because they'll have to close quickly or they need high leverage. So usually people come to us when they're under contract. In the case that somebody does need like a pre-approval letter, because that does happen, we can give that usually within a couple hours, as long as we can know, like a general number as far as purchase price, budget, estimated after repair value, and then just like some high points on the borrower, like what their credit score is, what their real estate background is. So if you can get us that like 5 or 6 things, I usually should be able to get you like some type of pre-approval.
Got it.
Properties,
and then
the address is important.
Yeah, I can imagine.
Yeah.
Absolutely. And here's a big one: rural properties. A lot of people think, this would be a great Airbnb. There's not a home for 30 miles. Everyone's going to love this. And they come so excited to get this loan. Why are rural properties, and what's kind of the, what do you say is a good lines, but why are rural properties not the best when it comes to getting a loan from you?
Yeah, I think it goes back to what I said earlier on the call, like the capital markets piece of it. Like it's impossible to move a loan that has a rural property in it. Nobody wants to buy it. So like it makes it like very illiquid. So that's probably why why we can't do it. We will do loans that are, as long as the population count is 5,000 or above, we usually can get it through. The other thing that's really important is the designation on the appraisal. So even if it's like a 7,000 person county, but the appraisal designates it as rural, that's probably something we wouldn't be able to do, or at least we would have to like really lower leverage, again, because like there's not a lot of liquidity in those types of loans, so you can't give us high leverage. In DSCR, you probably can't do rural at all. Bridge has a little bit more flexibility.
For DSCR, what would you say the population requirement should be?
DSCR really is the appraisal. Like it's going to come the appraisal designation, at least for my company, because like that we can't do rural period for DSCR. And there's definitely been times where the population count has been under that 5,000 but it's been designated as suburban for, it's close enough to a big city or something like that.
Right.
So it
And
really comes down to the appraisal. And I would say, like, ask your real estate agent because they're the ones who will know. I think that's where you were about to go with that. Like, ask your real estate agent because they're the ones that have, like, we're a nationwide lender. Sarah lends nationwide as well. Like, we look in every market in the US. Like, we might not know your small market that we've never heard of. We won't know it, in fact. So ask your real estate agent because that's their specialty. It should be like that's where they sell property. So.
And that is the perfect recommendation because that'll save you a lot of heartache of instead getting the property under contract, then coming and finding out that it's not going to work. Asking that real estate agent ahead of time saves a lot of heartache and time as well. I totally agree on that one. I'm curious, Max, what do you enjoy about what you do? What do you enjoy about being a loan officer?
I like working in the private space, especially because it moves really fast. I look at, like I told you, like I look at probably 20 to 25 deals a day. They're all over the country, all different types of deals. Like some are like we're working on a deal that's burned down on the inside right now, like to some deals that are like luxury SFR rentals. So it's all over the board. And like I'm passionate about the real estate and like I like networking and that type of stuff. So, and I also I like money, and I think that like this type of job is just like the numbers are everywhere. You can like that's all it is really. So like it's a good fit for me for all of those reasons.
I know it sounds all and it's interesting. I mean, what you and I do is very different, but I mean, I'm fascinated by what you do. I mean, it's a very different skill set, obviously, and you're dealing with a lot more numbers than I am. Last question, I promise. I know you've been doing this a little while. What would you say? What's the hardest loan? Do you remember? Is there anything that sticks out in your mind? The hardest loan you've worked on that you got across the finish line?
Hardest loan. We did last year, we did one in Myrtle Beach that was a motel conversion to multifamily. And it was just really hard because the borrower had never done a conversion before. And like, I don't know, he had to basically like, he had to put kitchens in every one of the units because it's not multifamily unless it has a kitchen. So like he had to switch contractors multiple times throughout the process. We ended up introducing him to a contractor that like ended up finally working, and we got the deal closed. So I mean, I would say that was probably the hardest one, and that took maybe like 3 or 4 months. Like I said, we're usually a quick lender, so like anytime that I have a deal that sits on my desk for like more than a month, it's probably like not going to work. Probably as soon
Yeah.
we were able to solve past all that stuff. It was 36 unit motel to multi conversion. So that was a good one.
That actually made me think of one more question because we didn't touch on construction whatsoever. So you guys
Yeah.
can do construction loans, which a lot of people don't even really understand what that looks like. On construction loans, what are kind of the biggest factors you're looking at? Experience, I know plays a big part, which a lot of people aren't aware of. They think, hey, I just want to build some rentals. Let's do it. But
Are we talking ground up construction here?
yep,
Yes.
ground up
Ground up
construction.
construction, that's the only one of our programs that has like a threshold to qualify for. You have to have like at least some like serious fix and flip or have done ground up construction in the past. That one is also it's like structured a bit differently than other types of loans because it's based on blended loan to cost. So the way it works is like you say your purchase is 100,000 and your build budget is 200,000. Our loan is going to be based on 300 on a percentage of the 300,000. Whereas like in other cases, you have like it's more separate. Like you will do like 80% of the purchase, 100% of the budget, and like you come to a total loan amount that way. This one, it's all blended. So like if you're doing 80% loan to cost, the borrower's 20% needs to be the first money. Like in some cases, like borrowers, you'll have to cover like the full purchase price in some cases. Sometimes you'll even have to cover like a portion of the budget. It's dependent on that blended loan to cost. So like
Sure.
usually like 75 to 80%. And it's priced a little bit higher as well. Maybe like 11 and a half, maybe starting for ground up and up to 13.
And we've run into this as well. What about if the client, they've already purchased the land, and they've, done some groundwork? How does that come into play in that type of a loan?
Yeah, so it will still be based on that, like I said, like the blended LTC. But we will be able to factor in things that you've spent already. So like if you've already purchased it and you've already spent 100,000, we can factor that in. We just have to validate it. Like if you have receipts
Sure.
or images, we have to be able to validate it. But yeah, it would still be under that same LTC calculation.
Awesome. And on ground up, what is your minimum? What is your maximum loan
Same deal.
amount?
I would
Same.
say,
Okay.
yeah, I would say maybe, 150 is still fine. I don't know how much you could build for 150, but I'm sure we
I
can
know.
do it. But yeah, up to 5 million. And that one, I would say like hard stop at 8 units for ground up.
Okay.
Can't really do bigger stuff there. We can, you guys as well. Like we have referral partners. We could help you. We can introduce you to someone that can do it, but
Sure.
Most top of 8 units.
Got it. Can you think of anything else that I didn't touch on that you?
No, I think you touched it all. I think maybe like mixed use is maybe the only thing, like
Hmm.
mixed use as well.
Yeah. What
Like
even is mixed use? Some people don't even know what mixed use is.
yeah, so we're largely a residential lender, but we can do mixed use as long as the property is greater than 50% resi by the square footage and
Hmm.
greater 60% resi by the income.
Okay.
Mixed use usually like what we get is like if you have ground floor retail with maybe like a couple of apartments upstairs, that works for us. Ground up mixed use works too, capped at 8 units, but you can do that as well. You know, a lot of times like if you're somebody that's like looking to do fix and hold,
Hmm.
mixed use is a good option because that ground floor retail can take down a big chunk of, you can charge more. So, that's why people like it. It does make it a little harder for exit financing sometimes. Banks don't typically give the same leverage to a full multi as they would a mixed use property. So that might be like a potential risk on doing it, but you can demand more rent for sure.
Absolutely. And if you're purchasing a mixed use property, are you looking at it almost in the same way as a DSCR? Are you looking at what the rent is on the residential and the commercial piece, and that factors into the loan?
So on mixed use, I only have bridge loans for mixed use. I don't
Got
have
it.
a DR loan for mixed use,
Got it.
but even on the bridge loan, you have to calculate your exit DSCR to make sure that
Hmm.
they'll get out of our loan.
Got it.
You have to calculate at least a 1.2 exit DSCR, and
Okay.
that will be using like the borrower's pro forma numbers, so like what their expected income is
Sure.
for later on.
Got it. Which actually, sorry, one more we didn't talk
Yeah,
about.
no worries.
The vacant properties is somehow people think that they can't buy vacant properties with a DSCR. They think, oh, there's
No,
got to be a renter in there.
sorry,
You
sorry.
can. No, you're good. So you can buy vacant.
Yeah, you can. It is if it's a vacant purchase, it's going to be based on 90% of the market rent.
Hmm.
The DSCR calculation is going to be based on 90% of the market rent, I should say.
Got it.
So you might not like you might get dinged a little bit on your DSCR. Like if that causes you to go below the 1.15 threshold, like maybe you're going to qualify for like a slightly lower leverage, but it's definitely still out.
Got it. Okay, that's good to know. Somehow people think that's not going to work. And then Airbnbs. Can you do loans for people buying Airbnbs?
We can. Again, it's lower leverage though. So it's going to be Airbnb's capped at 65%.
Got it.
So that's the one where borrowers over, the 35% down payment is a lot for some people, but that's what we can do for Airbnb. If you want to do a bridge, I probably could get more like 75, but that's a 12-month loan.
And if I already had an Airbnb that's functioning, it's making a great killing on rent, and I want to refinance it, are you looking at my Airbnb numbers or are you looking at market rent?
Market rent. And it's going to be 90% of market rent because we have to treat that as a vacant property.
Got it.
But that usually doesn't hurt as bad because the leverage is lower. It's 65%. So usually that all works out. Every while you run into an issue, but I just need to make sure everyone's aware of the rules so nobody's surprised when stuff happens.
Right. Absolutely. Thank you, Max. Here, unless you think of anything else, I think I covered the full spectrum.
No, yeah, you did great.